The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. And now, please welcome your hosts, Mark Longo, Mike Cavanaugh, and Eric Cott.
All right, and that beautiful Bond-esque music means it's time once again for the Advisor's Option. And my name is Mark Longo from the optionsinsider.com, as well as all of the programs here on the old Options Insider Radio Network. And we are a wee bit shorthanded here for episode 2 of the Advisor's Option, but we're none the worse for wear, because I am also joined here today by good old Mike Cavanaugh from Know Your Options, Inc. Mr. Cavanaugh, welcome back to the program, sir.
Hello, Mark. Hello, listeners. Great to be back for episode 2 of the Advisor's Option. Ready to talk about more of how to use options for your clients.
All that exciting, fun stuff. And like I said, the OIC couldn't join us, but Mike and I couldn't wait. We were chomping at the bit to get yet another episode in before the end of the year. So here we are, and without further ado, let's dive right into our continuing education segment, also known as Options 101.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
And welcome to our CE, aka our Options 101 segment. This is where we sit back and we discuss all of the minutiae and the interesting details and intricacies of the options market that makes it sometimes difficult for newcomers, particularly new financial advisors and new asset managers, to really dive into these products. And on the last episode, we discussed primarily buying options, in particular the long call position, because that is one of the primary starting positions for a lot of new options traders, and it's also one of the easiest to wrap your head around. It eventually evolves in some way, shape, or form into a long underlying position, or is equivalent to that. And so most financial advisors, most asset managers understand long underlying positions because they're using them already, so it's easy for them to migrate and wrap their heads around the long call position. But we briefly, and correct me if I'm wrong, Mike, but we briefly touched on the long put on the last episode as well. We held off on that one for the last episode because it's a little bit more of a counterintuitive type of position for a lot of newcomers to the option space. People can easily wrap their heads around buying a call and then exercising it and getting long the underlying stock. That's a relatively straightforward concept. But buying something which gives you the right to sell something, a little more counterintuitive. It's usually an extra step, an extra leap of logic for people who are first coming to the options market. And I hear this a lot from new advisors, new asset managers, or even new retail who are coming to this space for the first time and kicking the tires on these products. And they say to me, yeah, I understand the calls pretty easily, but when I start getting into long puts and getting short the underlying, that's a wee bit more counterintuitive for them. So we're going to walk you through that again, and then get into some of the specifics of what a long put can do for you and the myriad, dare I say, uses that it can be put to for a financial advisor. So we'll start off once again with the basics, the definition of the old long put, which is, of course, the right but not the obligation to sell a specific stock by a specific date at a specified price. And think about it intuitively. What would be the use for something like that? Let's say our good old friend XYZ stock is trading at 100 right now, and you are a financial advisor, and you're saying to yourself, well, I don't know if XYZ is going to go down over the next year or not, so I'm going to instead lock in the ability to sell XYZ at 100 for the rest of the year. So I'm going to go out and buy a 100 strike put option on XYZ stock that expires in December of 2012. And by doing that, you therefore lock in the ability to sell that underlying at the price of 100 for an entire year. And just thinking of it in that sense alone, I think a lot of advisors and asset managers will start to understand the value of something like that. Locking in a selling price for a particular year is a useful thing, with the understanding that you don't have to sell that. If the stock takes off in the other direction, you can still participate in all of that and all of the upside, but the put gives you that right. It locks in that selling price. It locks in a floor to any advisor using these options. And so once you have that locked in selling price, there are a lot of ways you can use that if you're an advisor. Well, obviously the one I just mentioned, which is probably the most starting point for a lot of new options traders, is the speculative use of that. You're looking at XYZ stock, you think it's going to go down. You want to take advantage of what we discussed in episode 1, the leverage, the buying power of options to speculate on that downside in that stock. So you come in and buy a speculative put position on XYZ stock at the 100 strike that expires in December of 2012. So you have an entire year for that position to go in the money, as it were. And then over the course of that year, as the stock drops, you can sell that option, you can exercise the put, you can do a number of different things that give you essentially all the profit potential of shorting the stock at 100 without the risk and without the added cost and the
capital requirements.
Yeah, exactly. Without the capital requirements.
I'm here to
yes.
ad lib for Mr. Longo.
You're my Ed McMahon in today's episode.
Yes.
You are correct, sir. Yes, without the capital requirements of shorting the stock and having to maintain all of that margin for the entire 1 year period. So that is probably the starting point that a lot of people come to it for when they're looking at long puts for the very first time. And then I think for a lot of advisors, the starting point for a lot of them is, of course, the protective aspect of that put. Instead of being a long speculative put, they actually pick up a protective put, which is also in some parlance known as a married put if you do it one-to-one, but we'll stick with the protective put lingo for our purposes here. And what that means is if instead of looking at XYZ on a speculative basis, you are now an owner, and let's say you own the underlying of XYZ stock already, you've held it for maybe a year or so in your portfolio, you bought it at 75, this XYZ has now rallied to 100. And now, for whatever reason, a variety of reasons that advisors might encounter, maybe tax-related, maybe there are prohibitions in their portfolio that prevent them from selling it, or maybe they're just not sure about the near term, they want some downside protection. They can come in, and instead of selling the stock at 100 and locking in those gains, they can buy that 100 strike put at whatever month they choose, depending on how much protection they want. And for the lifespan of that option, that will give them the option, quote unquote, or the right to sell that stock at the price of 100. So that's a useful protective measure if you're concerned, if you want to maintain a long underlying position and you still have some bullish outlook on that stock, but you're perhaps uncertain about the near term of that stock, or you're prohibited for a variety of reasons from selling it, but you still want to maintain that long position. Mike, you have anything to add to that?
I think what's helpful for advisors when they're first getting into understanding options is to take a look, what am I actually doing? And a lot of people won't understand this, but to visualize it, you take the long call on XYZ, the December 2012 100 call for whatever premium it's trading at is synthetically the same thing as buying the stock in the 100 put.
You said the S word, the synthetic word.
And I'm going to say derivative, too. I know we had some
Now we're really scaring people here.
cars going off the road on the last show when we said derivatives. But just doing a comparative analysis, most of the brokerage firms out there, whether you're using Schwab or TD, Options Express, they'll have a trade calculator as part of their offering to their clients. Well, get in the trade calculator and buy XYZ 100 call and buy the stock and buy the XYZ 100 put and do a comparative analysis of what that looks like. That'll start helping you wrap your head around what you're physically doing. Now, that right there should trigger a whole bunch of questions. Well, if it's synthetically the same from a risk-reward perspective, what would the advantage be of buying the stock and the married put versus just buying the call outright? And what you really need to know is the understanding of what the trade-offs are in buying the stock and owning the put versus just buying the call. Write down a T-bar on your piece of paper with pros and cons, and what you'll find are the owning the stock with the married put from tax purposes and dividends are the advantages, and the trade-offs are the capital requirements. The trade-off for the just buying the call outright is less of a capital requirement, but you don't get the same tax treatment. So just having a high-level understanding of why you're doing something is extremely important with options, so you don't get caught in a situation where something that you didn't think could happen happens. Just looking at the married put, you own XYZ stock and you own the put, it better be because you own the stock, you want to continue to own the stock for a dividend, or you want to generate a long-term tax preferential treatment versus the short-term tax preferential treatment. A lot of times people have stocks in their portfolio that they don't want, that they're emotionally connected to. If that's the case, a married put's not a bad idea either. The easiest way to explain the put option to an advisor or an advisor explaining to his client is for the purpose of insurance. If you go 12 months out and buy the illustrious XYZ 100 put, you're basically you're front-loading 12 months worth of premium to insure that position for that period of time. So if you want to make it more stomachable, you take that number and you divide it by 12 and you say, that's basically what your monthly premium to insure this position is. And if you're in that for the right reasons, you're going to continue to participate in the upside of the stock above the premium that you pay for the put. And like you said, if you have a short-term bearish feeling or bearish sentiment on the stock, you can play that bearish sentiment by saying, I'm going to keep the stock long-term for the dividend and the tax break or the long-term tax treatment. And if it goes down over the next 6 to 12 months, I'm going to profit on the put if it goes down further than the premium I paid for it. And I'm going to use that money to reinvest in the stock. So the right way to do things with options are to hedge risk, understand and assess the risk involved with what you're doing, and then moving forward with the right mentality.
Exactly. And with options, of course, there's a trade-off for everything that you do. And with puts, there are no exception. You mentioned some of the upsides, some of the advantages to doing that protective or that married put position, as opposed to the long call position where, for example, you have a client, like you said, who is attached emotionally to a position, doesn't want to get rid of it for whatever reason. This is a good way to accommodate for that and still incorporate some reasonable downside protection, also tax treatment, and also dividends, voting rights. There are a number of other issues that are of benefit to the end user for owning the underlying. But of course, you do have that offset, which is that capital outlay. And the downside of course, coming in and buying the protective put is that at the end of the day, insurance isn't free. There is no free lunch when it comes to the options market. These market makers in the options market are not going to insure the downside of your portfolio for free. They're going to make you pay for that. And depending on the volatility environment that you're trading in at the time when you purchase that protection could be reasonably expensive. And so if you're an advisor, you need to weigh the price level you want to lock in versus how much of those returns you're willing to surrender to pay for that protection. And it could be in that aforementioned example of the 1-year option. That's a very long-term option. That is going to be relatively expensive. Let's say in our example, if you own XYZ from 75, the stock has rallied to 100. Now you decide to buy that mythical December 2012 XYZ puts at the 100 strike, that could cost, let's say, $10. So now you're essentially surrendering $10 worth of your profits to lock in that 100 strike price. So essentially you're locking in a price not of 100, but of 90. So you need to weigh that in whenever you're looking at a protective put level. And the reason I mention that is because we talked on the last episode about the Greeks, and one of the fundamental Greeks for financial advisors is theta, or time decay. And the initial reaction of many financial advisors when they start to discover protective puts and all the magical abilities that options can offer as insurance, they immediately gravitate towards front month or very near-term options because they are cheaper. They're the cheapest options on the chain. And they look at the 1 year options, like we said, that could cost $10 for that 1 year worth of protection. And that number is scary to them. They see, wow, I'm going to give up $10 of my profits, or I'm going to pay $10 on a position I just started just to defend this price level. Is that really worth it to me? And so a lot of advisors make the mistake of buying front month, very near-term options. God forbid they dive into the weeklies and start doing it that way. Maybe some of them are doing it that way as well. But when you take that initial approach to it, it looks good at first because you're paying less and your initial outlay is less, but it doesn't maximize that variable we discussed last episode, which was theta. And as we discussed last episode, theta increases, I hate to say exponentially, but at a nearly exponential pace as you approach expiration, particularly in the final 2 weeks of an option's lifespan. That may vary depending on the option, but it usually is around the 2-week level that a significant percentage of that option's time decay occurs. So if you are doing nothing but buying front month protective puts and then rolling them every month, you may be in the initial outlay spending less, but if you maintain that same position over that same hypothetical 1 year period, you will be paying substantially more in terms of time decay and in terms of overall premium than if you just came out and bought that 1 year period of protection initially with that December 2012 put. So if you are an advisor and you are looking to implement a protective put into your clients' portfolios, you need to weigh your options there, pun intended, how many basis points you are willing to surrender of your returns in order to lock in a particular price point. And usually it falls somewhere in between that front month, which is not ideal, and that very long-term option. And a lot of studies that are the OIC, our partners on this program, have done, particularly on their collar studies, which is another position we will get to in some of the more advanced episodes. In their collar studies, they found that optimal purchase point, optimal period, to be somewhere in the 6-month time frame. It's the Goldilocks of the positions where it's far enough away from the initial time decay period of the front month options to save you on that front, yet it's not as expensive as a leap or a longer term option. So every position will be different. Every advisor will come to a different conclusion. As long as when you're doing that, you remember that you have to maximize your theta and not just continually go for the cheap options, because remember, they're cheap for a reason and you want to get the most bang for your buck. And of course, there are a number of ways that we will get to in future episodes, upcoming episodes, for ways to reduce the cost of that insurance, the cost of that protection, because that is a number one query we receive from asset managers and financial advisors on a regular basis over at the Options Insider. I really want to implement options as a protective measure for my portfolios. Constantly ask us, but it's just too expensive. How do I reduce this outlay? And there are a number of ways we will get into in upcoming episodes, including using put spreads instead of outright buying the naked long put. That, of course, gets into the concept of selling options, which we will cover in depth on an upcoming episode. We're staying long only right now in terms of buying the options. And then also there are other things like the collar, which is a position that incorporates another aspect we will discuss on an upcoming episode, the covered call. I know that's a position that you boys over here at KYO love, and that is a stock and trade position for a lot of financial advisors. So we will touch on in upcoming episodes ways that you can reduce that initial outlay for that protective put. But right now, for this episode, we want to really hit on the advantages of a protective put or just a long put in general, and the many different uses that an advisor could put that position to in his portfolio.
One of the advantages you note here that I think is in our notes for the show, so to speak, that I think is very important to convey to our listeners is the advantage of a put over a stop loss. The stop loss order is great when a market doesn't gap, when there's very little volatility, and there's no overnight movement. If you look at a lot of the activity in the past 6 months, and there were times in the past 3 years where you wake up and the S&P's down 25 points, and it continues lower after the open, and you never see an uptick during the day, and vice versa. There's been some days where the S&P's up 30, and it continues higher for the rest of the day, and there's big gaps in the morning, up and down. A lot of times a stop loss might be part of that gap, and you really don't have a chance of exiting or entering a trade at what you think is a fair price because of the big overnight gap. So I'm a firm believer that a put option gives you an innate ability to avoid those gaps. And like you were saying, there's always a risk transfer. There's a trade-off. And the time decay, the theta that you're paying for that option is your trade-off. That kind of insurance isn't free. Like you were saying before, there's no free lunch. Nobody's going to insure this without there being a cost. And you can put the stop-loss order in for free. There's no time decay incurred by having a stop-loss order resting there. But you kind of ask yourself, is it worth to go into a flash crash or a big gap with the stop-loss order in place that comes down to your stops you out, and then goes right back up, where if you're holding a put option, you avoid all of that mess entirely.
Exactly. I mean, imagine if you were back in that nightmare scenario of May 6th and you had a stop-loss down just above that cutoff threshold where the SEC and they came in and said, this is the threshold beyond which these trades are busted and these trades are legitimate. And I believe, what was it, 60%?
I believe it was
60% in that range. So let's say you had a stop loss at the 58% level or 59% level. That is an event that will be difficult to recover from in that portfolio's lifespan. And if you are an advisor who implemented that stop loss order and then was hit on that side and had that order triggered, you're probably going to lose that client on the other end of that because they're not going to be happy with that position, and rightfully so, nor should they be. That's something that's out of their control, very much out of your control, not something you really intended to have happen, yet it happens. And we still see this on a regular basis with a lot of individual names that have rapid swings. If you have clients who are trading some more illiquid names out there, every day in the Options Insider, we get lists from the various exchanges of trades that are busted, trades that are outside the normal trading range that were not acceptable for a variety of reasons. So this happens on a more frequent occurrence than some people would like to believe. If you are trading some of these smaller, less liquid names, it is worth keeping in mind definitely the values of a protective put versus that stop loss, which, like you said, can be triggered at will once it's hit, and you don't know where you're going to get filled or what price point you're getting for your client. And that is essentially a lot of risk you're leaving hanging out there for absolutely no reward whatsoever. They're not paying you to work that stop limit order. So you definitely want to keep that in mind. And it definitely, if you are concerned about that, it probably will be worth the added outlay of the option premium to buy a put over working that stop loss to protect your client. So yet another example, another reason why protective puts may be of interest to you. And it's also worth noting to our advisors out there that you can use protective puts and married puts in an IRA. So this is a very acceptable position for retirement money, not just speculative and active trading money that is coming to you. You can use this as a defensive measure in a number of different retirement accounts. So that's something else to consider if your clients are coming to you and maybe they're outside of the traditional realm, which you would be thinking they would be suitable for options. This is a position that could be used at any level, at any risk tolerance level of any client, even the most risk-averse grandmother coming to you, proverbially looking to go into the T-bills, you could still protect them with puts. So just to recap here, the long put is a very versatile, a very useful position. It is a position where an advisor will come in and pick up a long put or buy a long put, which will give you the right but not the obligation to sell the underlying stock at a specific price by a specific time. And by doing that, you can do a number of different things. You can speculate outright on the stock itself and speculate that it will drop to the downside, and you take advantage of the leverage that the put will offer you by doing that. Or if you're a long underlying holder and you want to maintain that position and you have a bullish outlook on that underlying, if you want to maintain it for a variety of reasons, tax reasons, voting rights, dividends, what have you, then the protective put is a good alternative for you. And as Mike alluded to, you should be aware if you are going to do that. Start looking around at some of the options websites like the OCC's website at optionseducation.org or at the Options Insider. We have a lot of educational information as well. Start looking into what we call synthetics and the synthetic positions, or just look at the profit and loss graph. It's very easy to do. Look at the profit and loss graph of a long call position versus a married or protective put position. And you'll look, just looking at those graphs alone will, like they say, a picture is worth 1,000 words. And when you see that those two profit and loss graphs are identical, then you will start realizing the downside or perhaps the trade-offs that you are undertaking when you pick up a married put position versus a long call position.
And it's funny because it's somewhat counterintuitive.
It's very counterintuitive to the new
that
option.
I'm bullish on this particular XYZ and I'm going to buy puts.
Yes.
It's extremely counterintuitive, but what you've done is you've basically said, I'm bullish. However, if I'm wrong, which we all know we are never wrong here on the advisor's option. We have yet to make a losing recommend. No, I'm just kidding. I've never met somebody that hasn't been wrong on some kind of forecast in the stock market. So the bullishness of the position is you will inherently make money if the stock goes up over the set period of time above the premium that you pay for the put. So it's the same synthetically as buying the call, and just understanding that takes out that counterintuitive thought that I guess what I've actually done is I've maintained my bullish position, but I've minimized the amount of what I could lose. If the stock goes to zero, my net worth isn't going to zero on this XYZ underlying. So it's a more conservative approach to being long, to being bullish in that particular underlying name. You have to analyze and balance the trade-offs between going long the stock and buying the married put or buying the call and move forward as such. So it's counterintuitive that if I think the stock is going up, why would I buy a put? Well, it's actually, I think the stock's going up. However, I have been wrong, and my forecast isn't 100%. Nobody's is. Only hindsight is 20/20. So if I'm wrong, I'm not willing to lose more than X, and I'm willing to pay Y in premium to protect myself.
And it's also worth noting in this very volatile environment that we find ourselves in, many advisors are looking for ways to provide added value to their clients. And a lot of clients are coming to people saying, not only can you improve my returns, but can you also limit my losses, limit my downsides, limit my swings in an environment like this. And so an advisor who is versed in buying long put options and knows how protective puts or married puts work and can incorporate them into their clients' portfolios will definitely have a leg up in this environment over the advisor whose only real defense against the multiple market shocks we've been experiencing of late is the old school diversification, buy 12 different stocks or perhaps buy a little bit of gold and a little bit of commodities here or there and diversifying that way. We all know that diversification, I should say, isn't what it used to be. And if you want true protection to the downside, the only real way to achieve that in this environment is by incorporating options into your portfolio. So with that, we'll close out our continuing education, aka our Options 101 segment, and roll right into our Tricks of the Trade segment.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
And that sneaky music means it's time for our Tricks of the Trade segment. And this is the part of the show where we try to give you some practical tips, some practical ideas, strategies for incorporating options into your portfolio. Because a lot of advisors, when they come to us and they're thinking about taking this leap of diving into the scary world of derivatives there, I'll use the D word. It can, yeah, exactly. It can be intimidating not only to them, but to their clients. And we used to hear a lot of advisors saying one of the main reasons they don't adopt derivatives or options into their portfolios is because they were terrified of scaring off their clients. And now, as we discussed in the last episode, that is starting to be less and less the case as more and more clients are coming to you looking for this. But let's say you still have an old school client who is used to just the buy and hold mentality and has never traded, never really looked at incorporating options into their portfolio. How do you get that ball rolling? How do you kick off that conversation? And Mike, I know you do this on a regular basis here over at KYO. It's one of the reasons we like having you on this program. You are knee-deep in the trenches of bringing options to the advisor community. So when someone comes into the KYO offices for the first time, and let's say they're a new client or maybe they're an older client, but you're thinking about adding their options to their portfolio for the first time, how do you typically get that ball rolling with them? Where do you start off with them in a way that isn't going to send them scrambling for the door as soon as possible?
it's taken a while, but you have to wrap your head around each individual client's going to be different. So it's subjected to their experience and what they know and their openness or willingness to learn new things. But let's just, a random John Doe walks in the office, says, hey, I've got X amount of money in a portfolio. I want to invest it in the stock market, in the bond market, and I want you to be my advisor. The way that we incorporate in that kind of a setting is we all have investor IPSs, investor policy statements, that you go through in order to learn more about your client's financial background and what's a suitable investment for that client. The questions go along risk reward. How much are you willing to risk to make a 20% return? Are you a 20-20 person? Are you a 10-10 person? Are you a 5-5 person? And then really start drilling down on what they've done, what they understand, what they know, and how that's working. So the conversation's very easy. It's, what have you done in the stock market, Mr. Investor? What has your advisor done? What have you educated yourself on, and how is that working? And once you really drill down on, does this person have an understanding of options? You start drilling down on their IPS, where it says, I'm a 5-5 or a 10-10 or a 20-20, meaning I can take the big 20% upswings with the 20% downswings. And then you give them a visualization with the options, saying, this isn't mandatory, but you said you're this kind of person. We can manage it in a cookie-cutter portfolio, modern portfolio theory, asset allocation model, and here's what it would look like. Here's what the same allocation looks like with a put option at 5% below the market, 10% below the market, 20% below the market. And you present it to them as insurance, because that's truly what it is. It's portfolio insurance. So they set the break points, and then you get the understanding of, can this person understand options? Have they traded options in the past? Have they used options as part of their investments? Now, most people say no. No, I've never used options. Not knowing that if they have an annuity or if they have any kind of structured product, that they've got a lot more options in their portfolio than what they think.
Yes, that could be a whole other episode of maybe the unknown options and derivatives exposure that you and your clients already have and don't even know about.
Venturing into the unknown.
Exactly.
Yeah, their options have been around forever. Listed options have been around since 1973, but they were trading options on tulip bulbs in Holland in the 1500s. So walking your client through, truly understanding, drilling down on the tough questions, getting the client's financial information, and then just giving them the visual to say, here's what a put option can do. Here are the trade-offs. Here's the risk transfer. You're paying X amount in dollars to insure your portfolio to this point. Here's what happens when the market goes up. Here's what happens if the market stays flat. And here's what happens if the market goes down. And once you've walked through that, most people will see the value in introducing and incorporating options into their portfolio. And it's not an all or nothing proposition. If somebody's somewhat squeamish, so to speak, on insuring their entire portfolio from day one, if they're too excited and you think they don't know what's going on, you may not want to put the entire portfolio under, but rather, hey, in order for you to get a better understanding, the 1,000 shares of XYZ stock you have, let's buy 2 put options. And let's monitor that. Let's have a weekly phone call or a monthly phone call to kind of go over what that position did within your portfolio to see if that's something ongoing that you're comfortable with. So 90% of your time for a client that comes in with little to no options experience, it's going to be education. And you have to be willing to invest in the relationship from an educational aspect, or partner with a firm like Know Your Options that is willing to walk you as an advisor through that educational process with your clients to get them engaged. That's for the person that doesn't have the knowledge or
First timer.
We're in a position, whether it's through our name or our experience.
It is kind of hard for you guys to get away from that options
Right.
name, because it is right there in the title.
We do have a situation where people come to us, whether it's by referral, word of mouth, or just because of our name. People come to us and say, here's my situation, what can you do? And when we had a client last week that's got X amount of dollars in gold bars that he wants to convert to gold coins, and the reason for that is he wants to start gifting the gold coins away to his grandchildren. hard to chip away at the
Yeah.
bar. Here, what's this? Oh, thanks for the gold nugget, Grandpa.
Here's some bullion, grandson. Enjoy.
Is that a tooth, Grandpa? No. So it's a viable reason to want to hedge gold, and we really started at a top level looking at hybrid modified collars where we're selling calls and buying put spreads varied over time, and walked ourselves down to really drilling down on what the need was. And it was just a 30-day time period from when he could sell the coins when they were converted from bars. There was a 30-day period that this particular special circumstance, there was 30 days of uncertainty that the client didn't want. And it just came down to the simple buying puts to ensure a massive move lower was the best case scenario.
And that's one of the few scenarios where it is permissible and indeed recommended to take that short-term approach, because you're not worried about anything beyond that 30-day horizon. You can just pick up that nice protective put, and then, or maybe even cover it off with a collar, and so you make it even cheaper, and then you're all set in that position.
So the long-winded answer to the question is, what do you do when the client comes in, whether they're a newbie or they're wise to the way of the world of options? There's no easy answer. The easy answer is you have to really drill down on the specific circumstance, the specific situation, the client's need, and the client's understanding. And that takes time. And the two good things that come out of that, your clients will very much appreciate the time and thought that you put into their situation in tailoring a specific insurance or a specific option overlay for their portfolio, to where you will have a client more so than the person that just says, yeah, we've got a specialist that'll slop something together for you. And then nobody's going to say slop something together for you. But I think the investing public has a keen eye in any environment, but I think they've got two eyes on everybody they're working with right now, not just in the financial world, everybody. It seems like the diminishing amount of trust in the world right now, corporate America to financial services, is people know if you're BSing them, and they don't want to be BS'd because they feel they've been BS'd for the last 50 years. So just
skeptical time in the world
skeptical
these
times.
days.
But hey, as an advisor, most advisors I meet in the independent RIA space are salt of the earth, really looking out for the best interests of their clients. They want to help. They just don't know the best areas to educate themselves and get the help. So great advent for this show, just as a resource for people to say, hey, that makes sense. That is me. That, I want to take that kind of time to really serve the needs of my client. I just don't know where to get the help. So getting the help is one part of it, but really investing in the relationship with the client. This is a great way to show that client that you are invested in their best interest for the long term, because you're not just slopping something together. You're really drilling down on the education and the coddling of the positions.
We're all about coddling the client here at the Advisor's Option. And of course, that is a good point to hit on. If you're an advisor who's showing the willingness to educate yourself and to educate those in your practice on implementing options, that's a necessary and a very positive first step to show your client that say, hey, we're looking into these instruments. We're committed to implementing them in a proper fashion. Because, of course, you don't want to sit down with a client and start that options discussion going without first being very well versed yourself, which is, of course, why we spend so much time here on this program uncovering the basics, uncovering the initial information you may need to arm yourself. And like we said before, if you want more information, there's a number of places you can go, including optionseducation.org and the old optionsinsider.com.
And Mark Longo's personal cell phone number,
yes.
the Mark Longo Options Hotline.
I will answer 24/7, day or night. Just call me up, and I will spend hours answering your personal options questions. You mentioned the percentages, the 5/5, the 20/20. A lot of advisors start there, and the traditional method has always been, come on in and tell me your risk tolerance level, and then I will plug you into my spreadsheet. And my spreadsheet, especially if you're one of the big wirehouses, it kicks you out into you should be 30% in equities, 20% in T-bills, 15% in some commodities, and XYZ across the board, and that is your asset allocation, and that is it. And I think the important part of that discussion to think about when you're discussing options is that options aren't an either-or scenario where if you're this risk tolerance, you should incorporate options, whereas this one you're not. As we discussed in this show, the options, they reduce risk. They are not risk additive, especially if implemented in the way we discussed here with a protective or married put. So These strategies, options, particularly in a defensive manner, can be applied at every risk tolerance level of your client. In fact, we would recommend them for some of your most risk-averse clients who still want some exposure to the market but also need that sort of protection. So you can take that proverbial 5-5 person, that really very risk-averse person, and say we can still incorporate options into your portfolio, let alone the 2020 guy who really is accustomed to some of the swings and wants to swing for the fences a little more, and maybe you take a little bit larger bets with him, maybe doing some ratio spreads and some other interesting things that could incorporate that strategy. So it's not exactly an either or where you have to meet a certain risk tolerance threshold before you can really be acclimated to or advisable for as a client for options. It can be applied at all levels of the client food chain, as it were.
It can be applied to all levels, and it's a great entree to get connected with your client. It's a quarterly conversation that you can say, here's what our advisor shop thinks the next quarter is going to look like. Mr. Client, what do you feel? Wow, I totally disagree with you, bozos in that shop. I love working with you as people, but I don't see it the same way you do. I mean, I can say as an advisor, some of our best clients are the ones that don't agree with us on our views in the market, and we give them the ability to tailor their account to the risks that they see are coming in the future. Not just personal risk, but, market risk. I think the Europe situation right now is going to do X, Y, Z to the stock market, and I want to be long puts, where the advisor might say, no, I think we could do this. And it gives you the ability to engage with your clients more and tailor their accounts more to what they see is coming, which, as an advisor, I can hear the winces out there right now. That a lot of times that's not the easiest scenario. I mean, you don't want to give clients too much control over the decision making in their portfolios.
The next question is, what am I paying you for? Of course, with that.
What am I paying you for? It comes down to just it gives you the ability to connect and engage with the client on a different level. There is no absolute saying everybody's going to get this. You give them a menu saying, hey, next quarter we're going to implement this unless we hear different from you. And the client may call and say, I don't want it, or I'd rather be at a higher protective barrier or a lower protective barrier or none at all, or I'm moving my accounts from you because I don't understand what these put options are doing. But it really gives you the ability to connect with your client and give them options on how they want their portfolio managed.
It is really hard to get away from that options word.
It is.
It's ubiquitous to what we do here on the Advisor's Option. And of course, in addition to the risk profile of the client, I think even what we discussed earlier in this episode or in the previous episode about the different ways that options can be used to preserve capital for the client, that could even be a starting point for the conversation for the advisor who perhaps is not as well versed in options, but can discuss the capital outlays of buying a call versus buying the stock, or like we said before, buying the long call versus the stock and put combination, or some of the other positions we've discussed. That alone, if you can wrap your head around that ability to preserve some of your clients' capital and take it off the table, it can be a way to get that conversation going on the opportunity cost that you can save them just by implementing a few options here or there. And by then incorporating that into their portfolio, they can then go on and maybe perhaps make an additional trade or put some of their other capital to use somewhere else. So there's a lot of ways you can start that conversation in a very easy, very simple way. And Mike, just anecdotally, I'd imagine you've been doing this for a while now and been having this conversation for a while now, but I'd imagine it's become somewhat easier of late, let's say in the past 6 months, with the general retail client, the general retail customer starting to become accustomed and perhaps a little more terrified of these regular systemic shocks we're starting to see in the market. The 30-plus handle moves in the S&P, the 300 to 400 handle moves in the Dow on a regular basis. I'd imagine those fluctuations, that higher degree of volatility we're seeing in the marketplace, makes this conversation a little easier.
It definitely makes the conversation easier when you continue to have the conversation more and more with people calling in. And I think the root of that conversation is most people that have been introduced to the stock market over the last, let's say, 50 years, they're introduced to save X amount of money each month. In 30 years, the money that you put in over time will and should be worth X amount of money. Last 10 years have now been coined the lost decade. but you're hard-pressed to find a long-term return that appreciates better than the U.S. capital markets. Now, is that going to continue in the future? I say yes. I don't see it changing dramatically long-term. Short-term, yes, there's a lot of uncertainty, but I think you're still going to be hard-pressed to find a better long-term investment in the U.S. capital markets. I do believe people have been introduced to it the wrong way. And the only thing that is left out of the introduction to investing is your money that you put in now is going to be worth X in 30 years. They don't tell you how rocky that ride can be.
It's the Warren Buffett effect. Just buy Coke and hold it for 30 years, and you'll do well.
Buy any stock for 30 years and hold on. You look at any stock that's made it 30 years. It's hard to find a stock unless you bought the top. But if you're dollar cost averaging in every quarter $100 from a paycheck or whatever it is, it's very hard to find a stock over 30 years that didn't outperform any other investment that you had, unless you got lucky and bought real estate in Alaska or whatever. The point is that people don't get introduced to the volatility, and volatility is a measure of emotion. So when you are at your emotional peaks is when the market is the most volatile, and when you're making emotionally based decisions, they generally turn out bad. So when you get introduced to, I'm putting away X amount of money in the stock market, and it should be worth X in 30 years, and 7 years in, you're way below your calculations because the market's down 25% or 40% like it was in '08. And now you're questioning everything that you learned and were introduced to the stock market, and you just say, get out. Get me out. I don't believe in this. This isn't something that I was told could happen. I was told I put this in, and 30 years from now I can buy my horse farm and wine ranch in southern Oregon, and everything's going to be fine for my grandkids and my grandkids' grandkids. When you look at options and what they can do for a portfolio, long term, I believe that the stock market will still go higher. Short term, I'll let you and me discuss what we think the short-term reasons to be cautious are. And then we'll set our levels of how aggressive we want to be in buying put protection to help take the volatility out of our return. So once we take that volatility out, we are also taking out that emotional presence that exists in the client-advisor relationship. So instead of a phone ringing and an advisor hiding underneath his desk on a day that the flash crash occurs, the advisor answers the call and says, here, Johnny, here's why we had that put in place. Now we have a decision to get aggressive on the offensive side or readjust our put or take the put off. Now we can make non-emotional decisions on our long-term investments because we had protection in place.
You planned ahead.
So you're basically that one piece of information left out of how most of us were introduced to the stock market, the volatility of the return. You take the volatility of the return, or you take part of the volatility of that return out by enhancing the portfolio with options, and I think you have a smoother path to what you were introduced to in the stock market.
I think definitely the moral of the story for any advisor looking to dive into the deep end of the pool here with options is that there's never going to be an easier time than right now to start introducing your clients to these concepts, particularly the defensive and protective aspects of options. They will be coming to you looking for ways to reduce their downside, to reduce the swings in their portfolio. So if you're looking to incorporate options into your portfolios, there has never been a better time than now. You definitely strike while the iron is hot. And of course, you can prepare for that day when we do have those massive down days again, and the client is calling up, and you, of course, will have planned ahead because you put on some protective puts in their portfolio. And that makes that phone call, I would think, much easier to take.
And I'll take that life example, case in point, and I am going to make T-shirts that say this. I had a client call in. The market was down the last couple weeks. It was right before the holiday. It makes the conversation so much easier to stomach when you're talking about options, when the client has grasped what options are. My client called in and he said, the stock was down X%, and I took your advice, and I bought a put option to where I could stomach the downdraft, and it happened. I didn't think it would, but it happened, and now I'm crazy about risk management, is what the client said. And I'm going to make T-shirts that say I'm crazy about risk management. It's a good feeling that, this is somebody that has been a great client for many years, but when he was first introduced to us, he was a weekend seminar warrior that was, promised he'd make X percent by
Swinging for
doing
the
this and
fences.
swinging for the fences, and realized that wasn't working, and said, all right, that's not working, so I'm going to try something else. And to the point, 3 years later, he's now crazy about risk management. It's music to my ears, but it's really the point that not only on this show, but other shows that we have with the Options Insider Radio, we've talked about it all the time, that these are tools for risk management or potential enhanced income in a portfolio. And when used correctly, it really takes all of that emotion out of your return, but also out of the advisor-client relationship, which I think is just as important, because when the market starts going down, throw all your Series 7, all your work experience, everything that the stock market to be out the window, and you, as an advisor, you basically inherited the job of being a behavioral therapist. When somebody calls in, you don't have caller ID, and they just call in and say, get me out of everything, and hang up, and you have no idea who they are, and you've got 2,000 clients, and you got to start calling all 2,000 people because one of them just called you and told you to get you out of everything, and they didn't say who they were. So
that's an argument for caller ID as well, I think.
So it definitely makes the phone call easier when the client makes the initial, hey, I want to learn more. I feel like I need to know more. What do I need to know?
I like that guy, the I'm crazy about risk management guy. That might be indeed a title for this episode. I like it. All right, and that is going to do it for our Tricks of the Trade segment. It's also going to do it for this episode of The Advisor's Option. I, of course, want to thank my partner in crime here, Mr. Mike Cavanaugh from Know Your Options, Inc. And Mr. Cavanaugh, what's coming up over in the land of Know Your Options that you think might interest our advisors listening out there?
I will say this, not in Know Your Options world, but we're really looking forward to the Options Industry Council's first inaugural Options Extravaganza, which is going to be the first weekend in May. I believe it's the 3rd, 4th, and 5th in New Orleans.
In New Orleans,
and I believe, Mr. Longo, you're going to be down there as well.
Yes.
We're going to bring some Know Your Options guys down there. I think we'll have 3 of our team down in New Orleans to meet the other players in the options world, so to speak.
Yes, we might be doing a big radio push from that conference. And if you are interested in options and you are a financial advisor, I believe our friends over the OIC who put on that conference might even be doing a special track for financial advisors this year. So if you're interested at all in options and you want an excuse to get away to New Orleans in May, this may not be a bad one for you. Swing on by to the old Options Industry Conference. And I believe you can find out more about that just by surfing over to optionsindustryconference.com, and you can see more about the dates and times and the agenda and what is going on over there. And of course, if you'd like to learn more about options and any of the topics we discuss on this program or on previous episodes of this program, then surf on over to theoptionsinsider.com. You can find all of the educational information as well as analysis, unusual options activity alerts, breaking news from the options market, and just about everything else you could possibly want from the world of options, let alone all of the other programs we have here on the old Options Insider Radio Network. There's quite a bit to choose from for you advisors looking to dive deep into the world of options. So that is going to do it for this episode. Of course, I want to thank all of you out there for downloading and streaming and subscribing to this program and making our first episode such a success. And we're looking forward to many more episodes of The Advisor's Option in 2012.
The Advisor's Option is brought to you by the Options Industry Council. For more information on how the OIC can help you implement options in your practice, please visit advisor.optionseducation.org. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.